Okay, this video we are looking at the weekly S&P 500 chart storm. This is a collection of charts which I've put together each week based on the S&P 500 and related markets. It looks at a variety of different charts. So in this week, got here in the description, institutional fund manager positioning, global market drawdowns, North Korea, etc., etc. And I put this into what we call a Twitter moment, which kind of helps in putting all the charts together into one neat little package. So here we go with the starting tweet. And this is probably about the first thing I'm doing today. It's early morning in my time, so if you hear me drinking some coffees, making slurping noises, don't be alarmed. First one here is North Korean missile launches against the S&P 500. Now, this one has been put together by the very well worth following sentiment trader. Very good service that they offer as well. So if you haven't signed up to their service, I highly recommend that you look into it. So what we've got here is the S&P 500 with these little downward arrows being the successful missile launches, which I guess denotes when the missile has gone up and then is coming back down. The key point of this really is that it doesn't really have a meaningful impact or an enduring impact by any means. We did get a comment there that, this one will only really matter when the missiles actually hit something, which you could call a blow-up top. I kind of joked. But it is a serious issue, and it's probably one of the key geopolitical risks out there. But, at the moment it's still in this sort of quietly swimming away mode where it's not really an issue until it becomes an issue. And the more of these that we see, the more likely it would become an issue, by the way. So number 2, from also a very good follow there, Ryan Detrick. This one shows major intra-year pullbacks for the S&P 500, MSCI EFI, MSCI EM, and the Nikkei. So just a couple of major markets there. And I guess, first of all, you'll notice that just about every year, at least one market has a fairly decent pullback. It was EFI in 91. Even some of the quieter years, like sort of 05, 06, there was still, we still saw a decent pullback. So that makes you think then when you see the current year looking very much like a bit of an outlier, and outliers exist. So, it's not necessarily a certainty that we actually have to see that, but still quite a bit of a year left to go, and there's, as I said, there's a few risks out there. Moving on to the next one, fund manager positioning. There's a lot going on in this chart, as I said, and it's very much well worth noting. It's from Irvin Carmel there, also another very good follower on Twitter. So what the chart here is showing is positioning versus history. And to illustrate, banks at the moment are very much a consensus long trade, and UK is pretty much the consensus underweight. Now, consensus can definitely be right, particularly when you're talking about fund managers, which tend to be, you hope at least a little bit more sophisticated. And for the most part they are, I guess. It's when the crowd is crowded and crowded for the wrong reasons that that becomes an issue. But anyway, probably the key points there is that you look at the top there, cash is also sitting up there very high, bonds down the other end. Now, some element of that overweight to cash, at least in my book, at least in terms of what I'll be doing, is that it's probably more of an underweight bonds, overweight cash pair versus necessarily being a purely defensive move. And you can see that there, that equities are still very much featured as an over. But one thing that's very interesting, and the one that brings it into the S&P 500 context, is that US is very much an underweight trade, and that's largely valuation driven, because the valuations are much better in Eurozone and emerging markets and other parts of the world. So, arguably more upside to come on those markets. Number 4, this is the State Street Investor Confidence Index. This is a measure of investor sentiment which is not based on survey, but rather it's based on actual trade data from State Street's global custodian business. So the custodian business is, so whenever you have a fund manager running an account, either a separately managed account or running a fund itself, typically we'll have to have a custodian appointed to actually, hold the assets, and any trades or any activities then directed or informed through their custodian and reflected in that. That's how they get this information. And their custodian business is in the order of trillions, very substantial. So what you see here, the 100 line is where there's either no money going to bonds or no money going to equity. It's sort of neutral. Anything above the line is increasing equity exposure, and that's probably the key point on this chart here, is how we've had a bit of upside capitulation by institutional investors. Next one is from Leufold Group, who put some interesting charts out. And this chart shows that the weight of the 10 largest companies in the S&P 500 is actually still below average, far from what it was during the dot-com boom. But it is still very interesting to note, though, that you look at that, it's about 19%, it's almost 20%. The top 10 companies will make up almost 20% of the index. So it's that's something worth thinking about. Next one, an alternative view of volatility. This red indicator looks back over the past 252 trading days, i.e. 12 months, and counts the number of moves in the S&P 500 on a daily basis that were either greater or less than 1%. And it is at an extremely low level. It is almost at the low point that we saw at that time. Figure it's 95. I believe it's off by about 1. So it's 13 at the moment, it was 12 then. So 13 1% trading day moves across a whole year. Pretty stark statistic there, actually. And well, for that to go lower, I looked at the numbers, and you'd need to see another 30 odd trading days without another 1% move for the other ones to roll off, and for that to actually head lower. So, calling a low in this is probably pretty easy at this point to call the low, but whether how long that low lasts, the low can actually last for some time. What to watch for on this chart is when it turns back up again, because that can signal a change in market regime. On to the next one. So one consequence of low volatility is, if you maintain the returns, a higher Sharpe ratio. And I'll leave you to read that one, but basically you can see that there's been an incredible tick up in the Sharpe ratio for the S&P 500, the rolling historical one. Number 8, NAFTA equity markets. I'll leave the politics aside, because there's plenty of reasons to do that. But looking at this one, there's a couple of things that NAFTA equity markets have in common. The first one is that all of their central banks are hiking interest rates now. Bank of Canada, Mexico Central Bank, and the Federal Reserve all are in rate hike mode now, as of last month, a few weeks ago rather, when Canada hiked. The other thing they have in common is earnings growth. All three of them actually have positive year-on-year EPS growth now, but it's quite very much different. So you can see US there, it's a lot less volatile, but also a bit quite substantially slower. Canada, I mean, that looks like base effects there driving the bulk, if not most of that. Whereas Mexico has actually been quite buoyant there, and also very much more volatile. And taking the NAFTA markets a little bit further, looking at a valuation metric, the PE10, price divided by average 10-year earnings. You can see very different pictures there. Part of that has some sort of reflection of the market composition. So Canada, there's a lot more energy sort of resource companies there, which definitely playing its role there. Mexico, a bit more on the consumer side, and US more on the tech side. So it kind of helps sort of reconcile that a little bit. But nevertheless, if you look at them, US is most expensive. It's it's up there versus its own history too. Mexico, second in line and looks kind of neutral versus its own history, and Canada is looking cheap versus its history and on a relative basis. So it's something to note. Sticking with the valuation topic, this is the cyclically adjusted price earnings ratio. It's slightly different from the P10. It throws a few other bits and pieces in there like inflation adjustment. This is Shiller's PE, and I guess the point on this one is that we may have entered into a new valuation range, and it's fairly clear that we have. If you look at that period there, and you might say, well, hang on a minute, this is like a new paradigm kind of speak. Whenever you hear somebody saying new normals, new paradigms, structural shifts, that's often a pretty good sign that you're towards the end of that theme. An example of that is in emerging markets. Emerging markets, it was a new paradigm, back around 2007, 2006, and there was all these structural changes and themes why why emerging markets were going to do amazing over the long term, and that turned out to be a bit of a peak for EM at that point. And of course, many people were talking about new paradigms, new ways of valuing the new economy, all that sort of thing around here. It's kind of fitting the story to meet the data. But there has been a clear shift, and part of that is composition of the index. We've got faster growing companies, more techy companies. The other thing is, think about factors such as interest rates. Real interest rates or nominal interest rates are incredibly low, very much lower than when they were around here. So that's another piece of information to draw in, and I think probably the participation in the market globally and domestically is at a structurally higher level. So we probably have entered into a new range, but even if we are in a new range, fair value is probably down at around this level here. Definitely not up here. So I guess my point on that would be that even if we are in a new range, that doesn't mean that it's not expensive. And that is the last chart. Some other moments down there, we won't look at those. And yeah, so if you are wanting to follow this, just go over and follow me on Twitter. I'll put the link to this in